Hello, everyone, and welcome to today's webinar. My name is Ben Harris, and I'm one of the co-founders here and also the president at DealCloud. Today, we're excited to share with you the results of the spring 2020 Dealmaker's Pulse Survey, along with some data-driven takeaways specifically for credit advisory, and leverage finance professionals. Before we get going, let me take just a moment, review a couple housekeeping items with you. As I expect many of you are, we, the DealCloud team, are all currently working from home, so there may be an occasional noise. We hope you can excuse that. As the Zoom experiences high usage and volume, we may experience a couple connectivity issues or slowness. While it's unlikely, it is worth mentioning if we or you have any issues. The session is being recorded and will be sent out to all after the webinar is finished. And lastly, participants can submit questions during the webinar via the Q&A function. We're actively watching this and monitoring this, and we will answer questions at the end of the presentation. We'll leave plenty of time for that. So we would welcome your feedback and your questions throughout the webinar. All right, with all that said, let's get started and jump in. Let me talk just for a minute here about the company and my background and where a little bit of this effort originates. So we've been working at this for a decade plus and building software for the vertical specific end markets across investment banking, private equity, and a number of other sub verticals in the principal investing markets. And we work day in and day out with a lot of you and also your peers in the industry to help deliver technology that manages sourcing and origination and a lot of other functions, coverage functions within these firms. So, look forward to digging in here with you today and getting going. So let me give a little bit of more background about the survey. I'm excited to share the results of what we've gathered. But first, I thought it would be helpful to give some background on how we conducted the survey itself and how we were able to crunch the numbers. So we issued our Dealmaker's Pulse Survey during the last week of April. This was right after we were all grasping for answers in the COVID madness. So, good time to get a pulse on the market with the dislocation that had just occurred. And we invited a global network of private equity investors to participate in this survey. So while our audience today is credit, leverage finance, credit advisory professionals, a lot of these results are primarily driven from a private equity audience and private equity perspective. So we heard from a mix of our clients, but we also reached out to non-clients. So the effort here was to get a pulse on the entire market, not just folks that we work with here at DealCloud. So in an effort to get the best and most accurate intelligence, we keep all these responses anonymous in terms of who they come in through. And we'll be running this survey into perpetuity here a couple times a year. And we love your participation in the future, but we want you to know it's going to be anonymous. So the goal was to gauge the trends and issues in the market, since, as we all know, the reality on the ground has changed so much since March. And moving forward, again, I mentioned we'll do this about every 6 months, and we'll continue to focus the survey on overall market sentiment, a leading indicator around how folks are thinking about their sourcing, origination, and deals, industry best practices, and the technology they're using to help power and drive their firms forward. Many of you who are clients of ours will recognize this, but last year we built a technology platform that is very akin to tools like HubSpot, Marketo, MailChimp, Constant Contact, and our technology solution is called Dispatch. We built this after getting pretty overwhelming feedback from our vertical specific CRM clients that our tool and technology would be strengthened if it had email and web marketing capabilities. Now today, just in the about 10 to 12 months since its release, north of 10% of our global client base is leveraging this tool, helping collect marketing engagement data, perform surveys really just like this one. So a little bit of a plug for our own company, but we like to say we drink our own champagne because we too use this product to manage our company, our coverage and execution, and a lot of our marketing. And in fact, we actually used Dispatch, the technology, to deploy this survey, created the web page and the landing pages you've all seen. We distributed all the emails and questions and engaged the participants via this technology. And we also collected the anonymous results back into our technology platform. So the exact same technology we make available to the market, we are using to run and manage this. So if you have any questions about this, there's tons of information on our website, and also your client success and account management individuals who cover you would be happy to spend more time sharing more information about this. So as we jump in, let's get into the survey methodology here quickly, because this will give you a little bit of information about who we talked to and where this data is coming from. So I'd like to tell you a little bit about the profile of the investors who participated. So the results that you're seeing today are primarily from partners or senior level individuals at these firms. We are looking to get market sentiment from individuals who have lengthy tenure and experience in the markets and a very well-developed perspective. So many of these folks are members of the executive committee, as well as members of the investment and deal teams, across this private equity audience that we're surveying here. So the insights come primarily from senior leaders within firms of all sizes, and that ranges from boutique managers that have a couple $100 million under management and maybe 5 to 10 people, to very large integrated multi-strategy asset managers and top 50 private equity firms with hundreds of professionals that work there. So now that you understand the breakdown of who we talked to and where this feedback is coming from, let's dive into the findings from the report. So it's likely no surprise to the team here in this audience, but the deal makers we heard from are primarily focused on acquiring new businesses and putting capital to work. This is a standard trend that you see as more and more capital is raised. This makes sense. They've got to get it out the door. But additionally, a lot of attention will be paid to companies in the portfolio right now, primarily in terms of building the strategy there, either through add-on or bolt-on activities, or by leveraging operating partners and running growth strategies to actually improve the operations and grow those businesses. On another positive note, the majority of firms are not today primarily focused on the effects of COVID-19. So if you think about the time when this survey went out, everybody was checking in and working with their portfolio companies to see if revenue streams or the business would be disrupted. And while certain sectors did experience that, certainly consumer and automotive and aerospace and defense, a lot of our respondents said that countless disruptions to the private equity-backed companies will continue to occur each day, but the industry rallies around the idea of getting back to normal, or at least a new normal. So investors expect the market to restart soon, and the credit firms should be ready. While the deal volume has been significantly off and M&A volume has been significantly off in the March to June period, that everybody expects it will be coming back here shortly. So let's jump into our next question. We also asked deal makers what their challenges and barriers are to executing in today's market. And while we learned previously that firms are focused on new deals, they're overwhelmingly concerned about the volume of deals hitting the market. So because of, and I think the data shows this clearly in terms of what we've seen in March and April and May, the M&A volume is down. A lot of firms that have quality assets are not taking them to market, and a lot of investment bankers or advisors may be holding transactions until we're back to an updated or to a new normal. So the ability to see a lot of good deals and then also the ability to finance those transactions were the primary two concerns that investors are showing about executing during this time. But interestingly enough, the fourth most popular answer is just irrational prices still. So while we saw a big dip in April with the COVID news, the broader markets have returned and valuations for quality assets are still very high. So elsewhere in our survey, we've learned that about 95% of the respondents agreed that prices will generally come down over the coming weeks and months. And it's possible that the amount of dry powder available and the potential rush for deals might mean that although prices are coming down, it doesn't mean they're necessarily going to get low, right? There's a little bit of a supply and demand imbalance. And because of the demand, we think, that will keep prices up a little bit. So it seems there's a relatively high level of confidence in the management teams at the portfolio companies, which is a great sign. And very few express concern over their ability to manage their way through the COVID-19 crisis. So let's take a deeper look into some data that's particularly useful for the credit and leverage finance professionals that are on today's webinar. We were quite curious to see if interest changed across the size of each firm, but it seems that there's actually a fair bit of agreement in the market, whether you're a big shop with hundreds of professionals and billions of dollars or a small one. So across all these firms, investors are certainly worried about liquidity. They're insecure about the ability to secure financing and co-investment or clubbed investment dollars for large and complex transactions. These firms also seem to align in their prediction that deals will come in some of the more non-traditional forms, not just sponsor-to-sponsor transactions or investment banking-led private equity sales, but corporate carve-outs, and then groups will be looking to drive returns through recapitalizations of their portfolio companies, which I'm sure many of you on this call will take note of. So as we jump into the next kind of set of responses here, we also asked investors which types of deals they expect to see over the next month. So in order to help folks on this phone, the lenders like all of you, we decided to analyze those results and insights based on the firm size. So since the size of the firm or the amount of AUM is often an indicator of buying power, we thought this was a particularly interesting data set. As you can see, large firms are interested, more in corporate carve-outs and recapitalizations, and the smaller firms and the founder-led sales, but also the recapitalizations. So, similar distributions, but a little bit of difference in that corporate carve-out and in those recap numbers. So let's jump into kind of our big takeaways from the surveys and what we're hearing. Take some of these thoughts and ideas back to your firms as takeaways from the survey. So we're hearing that the relationship management aspect in today's kind of work from home environment is key. Proper coverage models for sponsors in terms of covering the intermediaries and the lenders that they know they can get deals done with is certainly top of mind for everybody. And also understanding where the deals are coming from. So we see, the corporate carve out and some other areas gaining popularity during this time, a little bit of the market dislocation. And so we're certainly seeing firms adjust their strategy and their pitch for who they are and what they can do and the type of transactions that they can do. And finally, a lot of groups are really, in the lack of some of that quality deal flow, are using marketing and marketing technologies to bolster their BD efforts and presence so that, they're staying top of mind with a lot of those deal makers that could bring them transactions. So this is certainly a big component. These were three things that we heard consistently from our respondents. And so if we dig in there and we talk a little bit about leveraging technology across those big takeaways, about half of our respondents said that over the last 6 months, tech and the infrastructure that they've invested in has allowed their firm to stay on par or even with their competitors. I think, we've certainly seen as the volume and the AUM of dollars in the private capital markets have reached the trillions and trillions, we have seen firms invest in the operations versus just running and managing in a single fund off of Outlook and Excel. And, while about half of investors are saying this is critical for them staying on par with the competition, about a third of the investors said that the investments they've made there and the infrastructure they have in place are giving them an edge or actually allowing them to win, in certain categories, whether that's sourcing more deals or actually winning transaction or opportunity they were on pursuit of. So I thought that was very interesting. And, what that means overwhelmingly is that, a lot of the market, and we're certainly experiencing this here at our company, that these private equity investors are using technology to help them better compete, to help them maintain and grow their relationships with bankers and lenders like all of you that are on the phone and dialed in here today. So if your lending and leverage finance operation is not equally as sophisticated, or you feel like it may not be, as in terms of the technology and infrastructure that are used by the buyers and sellers that you deal with, you may be placing your firm at a little bit of a disadvantage in today's market based on what we're hearing. And we know from many of our lending clients that, without a strong technology backbone, the sponsor coverage models and the intermediary coverage models, the due diligence processes that they can run get very messy. It makes deals harder to get done, and they tend to fall apart. So we're certainly seeing your peers across the leverage finance markets and the private debt markets make these investments as well. So if you feel that your firm's technology is not at least letting you stay on par, there are many technology and data providers that we can help with, and that we truly believe, that those solutions can help you and your firm succeed. And we'd love to spend more time talking about that with you. So as we jump into our final slides and takeaways here, I want to give you a quick summary of what we do for credit clients. It could be credit advisory, or leverage finance desks, or private debt investors out of a fund. But we offer a deal and relationship management technology platform, and this includes CRM, but the majority of the lenders and advisory firms that we work with leverage this for much more than that. It manages their sourcing, origination, coverage models, their pipeline, their diligence and execution of the transaction, investment committee processes, and certainly fundraising when they go back out to market to raise another fund. And while we've got all of that data around the deals and the execution, we repivot that across the relationships to help firms institutionalize their information for better market, regional, industry coverage models, and certainly keeping them efficient in the geographies that they cover. And then all of that data bubbles up through a man from the senior-most positions. So with that said, and the kind of plug and commercial there for the company and the technology, we'd love to open this up for questions and Q&A. And I think a couple have come in through the webinar while we've been on the phone here. So we'd love to spend that time with you. So we were trying to provide more co-investment capital. How can we use marketing to better highlight these offerings? It's interesting. We talked early in the session about dispatch and the technology. Most of our clients are using that to show off what they have done, whether that's tombstones or their experience in certain industries, or the number of sponsor-backed transactions that they've been a part of. There's a lot of ways that you can take the history of your firm and make that readily available to the market. And also, kind of hit a database of your CRM and most important relationships, and make sure that that's being constantly shown and reminded. So we're certainly enabling and helping folks to do that. And I think the other important point there is knowing where to go where you can do that, right? Who are the sponsors and the groups, and what are the transaction types that actually open the door to, if you're a lender and you're leading the credit, but open the door to some equity co-investment or warrant coverage. And we're seeing a lot of what I would call late stage technology lenders be very successful with getting those co-investment allocations. I think, down market in the lower middle market, we're also seeing a lot of lenders get some type of equity upside and warrant coverage. Obviously, as you get to the efficient, very large, syndicated loans or the liquid debt markets, it's a little bit more challenging, but we're certainly seeing that a lot of our clients are trying to pursue that strategy, and we're helping there. So another question here: what type of credit do you think the private equity firms will be looking for? This is a good question. It's broad in terms of what we, how we answer this. I think, coming into 2020, you saw very covenant light loans. You saw heavy leverage levels, and I think given the current time and some of the uncertainty about second wave and when everything will be reopened and when a vaccine will be released, you're probably going to see firms be slightly more conservative in their leverage levels, and they're certainly going to be looking for lenders and credit partners that are going to be flexible with them in terms of managing covenants and helping with amendments and adjustments to the current deals they've done. So I think you'll see the sponsors be slightly more conservative, and while they'll all be looking for credit up and down the stack, it's probably a little bit more conservative from a leverage perspective, and also they're looking for some flexibility in case the uncertainty in the market continues or there's a blip for any of their companies. We've got two more questions here, so let me try and answer those. We're a credit advisory firm and need to expand the number of PE firms we work with. Does your software help with that? Yes, overwhelmingly yes, to this question. So there's a couple things I'll highlight. There's so many ways that we support and help drive these strategies for our clients, but let me start by talking about our data cortex and the technology that integrates with a lot of the data sources. So if you're looking to map out the entire private equity universe through technologies like CapIQ or Preqin or PitchBook, pull that data down into your CRM so it's data-based and institutionalized for your firm, and then communicate effectively with some tiered-based strategy or some type of mass communication strategy, or we enable all of that, right? So while personal relationships and picking up the phone and working on deals together will never be replaced by software, if the goal is to really expand the network, use data and a data-driven approach to do that, and then try and communicate with that group more frequently, that is exactly what our technology was built to do, and what we're helping firms execute on every single day. And then I think the other way to answer that would be, for the tightest relationships that you have, really analyzing the data that's coming in. How many deals are you seeing from these sponsors? How many times are you touching them? Where do the relationships live between your firm and their firm? And we've got a lot of answers and capabilities to help execute on that as well. Here's another question. Will you issue the survey again? And if so, how do we participate? The answer is yes, we are doing this on a consistent basis. This goes out to our database of contacts and relationships, and we would love to get you in there. You can reach out to us through our website. You can email us at sales or support@dealcloud.com. You can download this survey that you've seen today at dealcloud.com/pulse, and we can grab your information there. Or you could obviously email anybody on our team directly, and we will get you involved in the next round of this. All right, so I think we're coming up on time here. I'd love to just take a minute and thank everybody for being a part of the discussion today, and we'll do a quick wrap up. So we mentioned it a couple times, but you can visit dealcloud.com/pulse to download our full report. We will be doing our next release in fall of 2020. And so stay tuned for that. And we would love your participation and look forward to sharing the results of that with you again when we get done there. So thanks everybody again for joining. We look forward to working with you on these surveys in the future.